Hi, I'm Jimmy. In this video, we're looking at the Genuine Parts Company, ticker symbol GPC. This video is part of our new Dividend Aristocrat series, where we're analyzing each of the companies within the Dividend Aristocrats ETF. The goal with this series is to see if we can find great dividend-paying stocks that have a good chance of paying reliable dividends in the years to come, ultimately getting us closer to our goal of financial freedom. Okay, so let's dive into Genuine Parts' business. Then we'll try to value GPC stock using both a dividend discount model and a discounted free cash flow valuation technique. So GPC sells automotive and industrial replacement parts. They have office products that they sell and electronic materials. They operate mostly in the United States, Canada, and Mexico, although they do have some international presence. Now, they recently made an acquisition where they're trying to expand their European presence, and that could really help grow their international presence. But for now, it's mostly just in the US. Although their Alliance Automotive acquisition should help them because the European market is very segmented compared to the consolidation that companies like GPC have created in the United States. So they really have the opportunity to consolidate throughout Europe, and that could one day help their business and really help their economies of scale and their growth. Okay, simple enough. So these are their segments broken down by 2018 revenue. And as we can see, the majority of this revenue comes from their automotive segment. And when we switch over to total revenue going back to 2009, well, we can see that revenue is growing. They've grown fairly steadily since 2009. Now, there was a bit of hesitation right there during those 3 years or so. But once again, since then, it started moving higher. Now, if we were to add gross profit and net income to this chart, well, we can see that each of them have grown roughly in line with revenue. Now, one of the things that jump out to me is how small the net income number is relative to both gross profit and total revenue. Now, this shouldn't be terribly surprising because most retail businesses tend to have very small margins, since a lower price often is one of the only ways to get to draw in more customers. So when we want to look at just the margins, this is net income margins, and we can see that broadly speaking, net income margins have stuck between 4 and 5% since about 2011. Now, I'm including analyst estimates in here. They're the parts that are highlighted in the green bars. Okay, now we have an idea of the numbers behind the business. Now let's look quickly at one of the key drivers to the automotive replacement parts industry in general. And then we'll try to come up with a fair value for GPC stock. So as we could guess, one of the main drivers of the auto parts industry is how old the average car is, at least in the United States, which is where most of the revenue comes for right now. Luckily, there's a company called RL Polk that does that exact kind of research. This is a chart of the average age of light passenger vehicles in the United States. And as we can see, the average age has been climbing quite consistently for many years. Now, this likely has a lot to do with the fact that the quality of cars has gradually improved, and cars can last longer now than they used to many years ago. But the older cars become, the more they need to be maintained, which is likely to lead to at least a sustainable business model for GPC. And the important part for us is the sustainability of their dividend as dividend investors. So this is GPC's dividend per share going back to 2002. And as we can see, analysts are expecting for that growth to continue. Once again, they're the green bars. Now, I think it's important to remember that this shouldn't be much of a surprise for any of the companies that we're reviewing this series, because one of the rules of the Dividend Aristocrats ETF is that all the companies must raise their dividend every year for at least 25 consecutive years to be in the index. So this shouldn't be too much of a surprise for us. Okay, now let's see if we can come up with a fair value for GPC stock. So right now, GPC has a dividend yield of almost 3%. And over the next 12 months, it's estimated that GPC will pay out about $3.05 per share in dividends. And if we would assume that their dividend growth rate is going to be 5% per year, which is about their average over the past few years, well, that would imply that the fair value of the stock would be about $107 per share. And given that GPC is trading at about 107, I think it's 106 and change right now, well, that would mean that their stock is fairly valued at the current level. Now, if you're curious about how we did this calculation, I actually did a video called Don't Overpay for Dividend Stocks. I've got a link in the description below, sort of walk through how this is done and how to choose the different numbers. But let's not stop there. Let's see if we can value GPC stock using the discounted cash flow valuation method. So this is what those numbers look like. Now I'm going to run through these numbers super quick, but once again, I created a video on how to do that. That's a longer video walking through every component of this, where you can find it, how you can calculate it. I've got a link in the description below. I even have an Excel spreadsheet, like a template that I created if you want that, link below. But basically, here's what we have. This is projected free cash flow. I simply took that from analyst estimates. Then I used a required rate of return of 8.5%. That's generally about where I want to be in line as far based on the risk of the company. Personally, that's one of my personal favorites. Although once again, in that video, I walked through some ways how you can calculate that. Then I used a perpetual growth rate of 2.5%. This is generally a fair number to use, somewhere in that area, maybe 3.5%, but I like to be a bit more conservative. I use 2.5% because that's likely to be in line with about the average growth of GDP over time. Using those numbers, we end up with a fair value of GPC stock to be about $99 per share. Well, as I mentioned a moment ago, GPC is trading at about $106, $107 per share. So it seems that according to both this and the dividend discount model, that GPC stock is at least fairly valued right now, possibly slightly overvalued, depending on which model you believe. So I think it makes sense to add GPC to a watch list until hopefully we get some sort of market pullback and we get an opportunity to get in this one at a lower price. Because historically, GPC has done quite well in recession. So if we're worried about a stock market crash, GPC could very well be a good play, even if our fair value, if it's about fairly valued right now, that might make a lot of sense. If we're overly concerned about a stock market crash, historically, this industry has done very well in market pullbacks. But personally, I like to add a margin of safety to my calculations to help me determine where to buy the stock. Now, if you're curious about how to identify where to buy a stock, this could be a good next video to watch, where I walk through the margin of safety concept and how to come up with that for each of your own company analysis. So, thank you so much for sticking with me all the way into the video. I really appreciate it. I hope you found this interesting. Thanks, and I'll see you in the next video.